All right, welcome to the iSoftpull main course podcast, season 1, episode 1. Super excited to be here. Glad to have Trent Ford, CEO of Saxton Mortgage, with us today.
Dan, thanks for having me. Glad to be on the inaugural podcast.
And we're going to be talking about soft credit checks as it relates to his mortgage company. He's been in mortgage for 15 years now, and he has 7 loan originators. And he actually used to be a general counsel and attorney in-house, right?
Yeah, in-house for a mortgage company.
So we're going to dig in right into the benefits, just go straight to the point of how soft pulls are helping them. And we were just actually talking about how you can calculate a debt-to-income ratio right of a soft pull. So let's talk about briefly, what are the benefits to the consumers when you do a soft credit check, and how you really separate yourself from maybe your competition because you're able to do soft pulls when other lenders aren't able to do it.
Yeah, no, I mean, absolutely. I mean, most people are protective of their credit score as they should. I actually tell people all the time, I actually have an 850 credit score. And so I am super meticulous and protective of my own credit score. And I always tell clients and borrowers that I treat theirs the same. And so just pulling a hard inquiry on credit before you know that they're going to actually be able to potentially qualify, because we do have, I mean, when you're operating with a 50 to 55 max DTI, a lot of times approvals are close. And so without having visibility to all of their liabilities, you're really guessing. And even when you do your due diligence and try to, ask the borrowers, things get missed. Student loans, there's a number of things people underestimate. And so what ends up happening is people are triggering a hard inquiry on their credit. They're impacting their credit score, and they don't really actually know if they're going to be able to get them qualified. And so to the consumer, depending upon where their credit score are, it could be thousands of dollars in difference. So every day we have people who are trying to pay down credit cards, rescoring, trying to get over a 680, trying to get over a 700, trying to get over that next incremental price difference. And if you run a hard inquiry on somebody's credit, they don't qualify, and they have to come back a few months later, we've got to re-pull credit. That can be the difference between being above a 720 or under a 720, and that difference can cost thousands of dollars in the pricing on the loan. So
when some of our sales guys are talking to mortgage brokers and mortgage lenders and loan officers, and a lot of the times the question is whether or not it shows the middle score, right? But what I'm hearing from you in our previous conversation was that you don't just get the score, you're more concerned about the underlying trades and calculating a DTI. Can you tell me a little bit about that?
Yeah, I mean, the score is the score. You're, without paying down credits, doing, credit repair, you're not going to change the score. So the score is the score. For me, I want to make sure that we're going to be able to qualify the borrower. And the other, as an originator, the other side of it too is I want to be able to get that borrower qualified before they're potentially getting, in this time, in this called day and age, as soon as you do a hard inquiry on credit, you're creating credit triggers, all kinds of marketing from outside companies. So for me, as an originator, I want to be able to make sure that I can get that borrower qualified, a true qualification, an accurate qualification. And so for me, using that soft pull inquiry, I can get all of those liabilities. I can get an accurate debt to income and know what I can get them qualified. I can get them further down the process where I have a very solid approval or solid DTI that I know I can get them an approval before I'm, one, impacting their credit score, and two, creating potential trigger leads and everything else where they're going to be solicited by their current mortgage servicer and everybody else who's out buying trigger leads, from the credit vendors.
So how do you get the debts? What do you do?
Yeah, so I mean, the soft pull credit report couldn't make it any easier. It lists out the aggregate of all of those, the total liabilities it has with the real estate. So if it's a refinance transaction without the real estate, and I grab that one number, $1,292, I take that, I add it into our LOS as a bulk liability, and then I know definitively what their total non-real estate trade lines are. And so from there, then I can look at and I can watch an accurate picture of the DTI When I start, figuring out how, if they're doing cash out, they want to know how high they can go. Or if it's just a rate and term refinance, I know exactly accurately what that debt to income is and whether we're going to have an issue getting them approved.
So is it a benefit that they're aggregated, or do you see any benefit that you can drill into the individual trade lines? Does that matter at all?
It does. And actually, here's how it matters is it happens all the time, every day, where somebody doesn't qualify based on everything they have. And so from at ease and from an initial first look, the aggregate number is all I care about. Because I'm going to assume that those accounts are going to stay intact, that they're not paying anything down, they're not paying anything off. Once I know that we're at a 62 DTI, then you start reverse engineering. And this happens every day. It's completely legitimate. It's above board. It's not a violation of Fannie or Freddie. You're just reducing their debt to income. And you're doing that by saying, how much do I need to reduce in their monthly obligation to get them under whatever that max qualifying debt to income is? And from there, that's where you look at the granular data. Okay, that $300 Amex bill, that Discover for $200, within the LOS, we just start clicking exclude from DTI, and then we ratchet down that debt to income to a point where we know we're going to be able to get them qualified. So having the visibility to each specific trade line, how much that payment is, lets you know which accounts. Then we go back to the client or the consumer and say, hey, I can't get you qualified how you are currently, but we do have a path to get you refinanced. We do have a path for, if it's a purchase, you're going to have to, this credit card, maybe, we have people paying off cars all the time. Hey, I only owe $5,000. I can pay that off. That knocks off a $500 payment. So you wouldn't be able to do that. You wouldn't be able to get pre-qualified if all you had was just the aggregate number. But as that initial first, where are we starting at? What's our starting point? The aggregate number is right there. It's easy. You don't have to add it up. You don't miscalculate. It gives it, that number directly.
And you're doing this off of SoftPull, right? So before SoftPull, I assume you were doing this exact same thing on a hard pull or on a tri-merge?
Well, a lot of people do. I mean, every day, more so than soft pull, people are just doing a hard inquiry on credit. They're just pulling credit. So as a business owner, I mean, credit reports are extremely expensive. When I started in the industry 15 years ago on the mortgage side, we were paying $12 to $15. Today, it's $30 for a hard pull. So they're almost triple the cost. So as a business owner, as the owner of the company, I mean, there's a significant cost savings by using the soft pull, which was actually, to be honest, the original reason that I was looking at it. I was looking at really the financial of like, hey, $30 versus a few dollars for a soft pull. Well, that makes all the sense financially. It wasn't really until I started using the soft pull that I figured out, or I was able to see all of these other really, frankly, particularly to the consumer, better benefits. But also too, I mean, on the originator side and as a company, all these other, not creating the triggers, not impacting their credit, not having to sell them a higher rate because now their credit score is under. It happens all the time. People do a hard inquiry credit. I can't help you right now. They come back 3-4 months and you can. Maybe they got a raise. Maybe they paid off some credit card debt, but you've impacted their credit score. And the two kind of go together because the people that are having trouble getting approved are the people that have high credit card utilization. People that have high credit card utilization are always going to have lower credit scores. It's just inherent in the modeling and with the FICO modeling. And it's, people don't understand. I mean, one of the biggest drivers of FICO is credit utilization. I can give you a real life example of a CPA that I know, multiple two rental properties, 100% payment history, came to me on a pre-qualification for a purchase. Her credit score was 680. Perfect history, making well over $100,000 a year. It was just high utilization. She came back to me 6 months later, had paid down a bunch of stuff. Her credit score had gone up to 780. And so, client that I did a soft pull on, I'm like, let me see where you're at. Let me see what we can do. And so, didn't impact her credit score. Again, somebody who already has a score that they're getting hit with loan level price adjusters. I mean, anything over 740, it doesn't really matter. You're not paying increased pricing on rate. above a 740. It's when you start getting under 740 that they start adding on these loan level price adjustments, and you're going to start paying for it in the rate.
So and from the business side, when you do a soft pull, how does that affect your compliance? When you do a tri-merge, you're given, if you don't do the deal, you're given adverse action. You might be given pricing notices. How do you handle that in the context of a soft pull?
Yeah, we still get authorization. I let everybody know, even though it's not going to impact their credit score. And that's, one of the biggest things, and one of the things I routinely get, like, hey, wait, but hold on, I don't want you to hit my credit score. My credit score is going to go down, right? Or whatever. It's so much of an easier, in mortgage, particularly sales, it's always trying to get people as far along in the process as you can. And I'll tell you, like, it's a high percentage of people who aren't 100% that they're ready to move forward. That will stop right as soon as you start talking about pulling their credit, because they know it's going to impact their credit score. As an originator, when you can tell them, I can look at your credit, I can get a credit score, I can see all your liabilities, and it's not going to impact your credit, you can, every time they're willing to let you pull it, because for them, you're giving them valuable information without causing this impact to their credit. And so for them, it's an upside. They're getting a visibility. Most people don't have access to their credit score. And so you're giving them visibility they normally wouldn't have, and you're giving them a free look without actually impacting their credit score.
Sure. So, and as a borrower, sometime even when I'm just shopping for a car or something, it's not just, a lot of the times it's going to impact my credit, but I have to take the time to fill out the long application. Have you found that by the limited information required, you can process that consent faster?
Absolutely. It's back to the compliance piece. You don't have to, we're not having to collect their social security number. And a lot of people are really hesitant. I don't, as the business, as the owner of Saxton Mortgage, I don't want people emailing their social security number. So when I can tell them that I can do it without collecting the social security number, because as you know, we don't need the social security number to do a soft inquiry, that creates less risk of us having to, but it eases the mind of the consumer in terms of having to provide, getting further along in the process and having to provide the least amount of information so they don't feel like they're backed into a corner, because a lot of people with identity theft and everything else are very guarded with their their personal information, as they should be. And for me, it diffuses me asking for a bunch of information that I really don't need. I just want to make sure I can get them qualified. And for me on the sales side, if I can get them qualified, if I can get them comfortable that I'm going to be able to get them into whatever loan product they're looking at with the most minimal amount of information, they'll give it to you once they're ready to move forward. They know they have to. But if I can get them further along in the process, and so one of the things that you had mentioned, I wanted to, or kind of talk about, there's today a lot more misinformation with credit score that was out there a long time ago. And I'll pick on Credit Karma or some of these others, but what people, and it has nothing to do with Credit Karma or any of these specific, they're using a different, I'm sure they're using a different scoring model. They're not, I think Credit Karma is using Vantage scoring versus FICO. So it going back 10 years ago when people started jumping on Credit Karma, we'd have people who'd call in, hey, my credit score is X. And then we would do a hard inquiry and it was nowhere near that. And it wasn't consistent that it was consistently worse or consistently better. It was just different, and it's a different scoring model. And so people are on Credit Karma, people are on all these different apps, and it may not, the score that they're looking at that they think they have may not actually be a FICO score, which is obviously on the mortgage side what you have to use. You have to use a FICO score. You can't use a Vantage score. You can't use some other methodology for credit score. And so again, back to the benefit of it is somebody may be misinformed as to where they stand from a credit score perspective, and being able to do that soft inquiry, not impact their credit, not have to collect all of their information, an easier process because it's quicker. They don't have to fill out this long application. With just their basic information, we can get a glimpse at it. We can provide them that information in terms of what's on there. And then we can give them a more accurate, look at what we could do for them on the mortgage side.
So what some people are going to say is, well, I need a pre-approval. I can't get the house unless I have a pre-approval letter, and you're not doing a pre-approval. So how do you say, like, all right, this isn't going to give a true pre-approval. We need to do X, Y, and Z for a pre-approval. But that's not what we're talking about here. right? How do you blend that?
Yeah, I mean, I think the people who want the pre-approval are the people who are concerned that they're not going to qualify. It's people that have higher debt to income, more liabilities, more revolving credit, lower credit score. And so those are the people that you have to talk over the edge to move forward. The people that are making a ton of money have, I just pre-qualified a guy is here in San Diego, younger guy making over $100,000 a year, no one Amex that he pays off every month. I mean, his debt to income's 20, 30%, or something like that. Those aren't the people or the clients that you have to talk into or that they're going to be able to get them approved. It's the people that have tighter financial positions. And so those are the people that you have to get comfortable from a sales perspective, in my experience. Those are the people you have to get comfortable that you are going to be able to get them approved. And so when you can say, I've already seen your credit, I know what all your liabilities are, I know what your credit score is. And based on that, I may not you can't obviously get a full automated approval with Fannie or Freddie through DU or LP without a hard inquiry, but you know where you stand from a ratio perspective. And for the most part, people who've been originating long enough know roughly what they can get approvals at and what they can't. And then two, obviously max DTI. I mean, you're not going to get an approval with DU over, 50, 55, something, whatever. So once you can get them from the sales side of it, once you can get them comfortable that you are going to get them to approve, my experience is that people are much more open to moving forward, completing the application, and then moving to, that's really typically where I move to the second phase of it and saying, okay, hey, I'm pretty certain, based on what I can see, I definitively won't know until we've ran it through DU. I do think it's worth it. And there's times when I have to tell people, I honestly don't think it's worth pulling your credit right now, a hard inquiry, because I'm not going to likely, unless you can pay this. It's not going to work. It's not going to work. And so, and people appreciate that. I mean, people appreciate the honesty, people appreciate you doing the due diligence to be able to tell them, because they need counseling a lot of times in terms of well, what do I need to do? Okay, you need to pay off this, you need to not go out, you need to, pay off that car, or you need to pay down these credit card accounts, you need to get your credit score up. You can, that's a big part of what we do is counseling people in terms of what's the best loan product, how we can get them qualified. You can't do that when you're guessing. And so that's where that SoftPull, the data, the information that you're getting from that SoftPull gives you the ability to feel confident that when you tell them, I am certain that I can get you approved, now is the time where, and sometimes people just want to know they're going to be able to get approved. They may not be ready to start writing offers. I've still got another 6 months on my lease. I'm just starting the process. But
what's my rate going to be? Where am I at, right?
What's my payment going to be? For the most part, people who think their credit's a little challenged or their financial position's a little challenged because maybe they don't make a ton of money, maybe they have a lot of revolving debt, et cetera. Those are the people that just want to know that they're going to be able to. And then they will, once they're ready, and some of them it's okay, hey, I am ready to move forward right now. Others, it might be 2 to 4 months out. And so for those people, you're doing them a disservice by pulling their credit today.
And so that leads to exactly what I was going to say is you say wait until the very end or as much as you can before you do the hard pull, because once you do the hard pull, it just triggers, it's trigger leads, right? But so much happens after that. You open yourself up to the rest of the market. It's going to impact their score if you have to do it 30 days later. Why, if you could summarize, why do you wait as long as you can, do all this pre-qualification, and then do the tri-merge?
Back to my credit score. I'm super protective of mine, so I'm super protective of other people's credit scores. There's probably a lot of people in big call centers that would say, you want to pull their credit, you want to get them, you want to push, and just contrary to kind of our sales philosophy. I always tell people the credit is the last thing that I do. And some of it's self-serving because I don't want to create that trigger lead. I want to make sure, as a salesperson, I want to make sure they're ready to go. And that as soon as we say go and I hit that hard inquiry, that we're pushing them into the loan process, creates less of a window for them to get picked off by a competitor or to talk to somebody else or whatever.
And you said credit is the last thing we do, but actually we're doing credit with the SoftPull, right?
Yeah,
so
just doing it behind the curtain.
In the normal sense, credit, when you speak about that, we're talking about doing the tri-merge. We're still doing credit. It's just not
completely.
right?
Completely. Yeah. And like I said, it's not for every file. I mean, a guy with a, who tells you like, hey, I pulled it up on my Citi Card app and it's an 800. If hey, I just bought a, whatever, or they pulled it,
And I make $400,000
and I'm
a
making
year.
400, yeah, and I'm making $200,000 a year, and I have no auto debt, and I've got one card that I pay off every month. I'm not pulling that guy's. I'm not doing a software inquiry. That's a slam dunk, right? It's a home run every time. Those aren't. It's the bigger percentage of people who aren't in that. Particularly, I'm
in San Diego.
I was gonna say I'm in Southern California, and it's hard to touch properties under,
750, right?
750, yeah.
$1 million bucks, right? Yeah. So we're talking about $1 million property, $750 to $1 million property on a guy that's making a joint income of $150,000 to $200,000, where you really got to squeeze it in for that debt to income ratio. I would say that's the most amount of buyers here in San Diego.
Yeah, I mean if you just use 50% debt, max debt to income, which I know you can go higher in some instances and stuff like that, but if you just use that as it's static across the board for fair lending issues. But the reality is that 50% debt to income for somebody making $4,000 a month is $2,000 of surplus or discretionary income or however you want to call it. I mean, the difference 50% of somebody making $10,000 or $20,000 a month is their discretionary income. You're talking about $5,000 or $10,000. From a practical standpoint, it would make sense to say, well, if you only need X amount, you only need $2,000, you only need $1,000 of surplus or discretionary income or whatever, but it would create massive disparity in lending, and so it would never happen. So it's a consistent standard that Fannie and Freddie have, and I wholly agree with it, because if not, you would have massive disparity in lending, and it would be a whole major issue. But the reality is that 50% DTI is so much different for somebody in a lower income than it is in somebody in a higher income. But it's and so the people that are making that higher income, and it's, depending upon where you are geographically, cost of living, stuff like that. Obviously, like we're talking about San Diego or almost all of Southern California, the Bay Area. And then, if you jump to the, East Coast and New York and some of these other, really high cost areas, yeah, I mean, it's a little different, but those are typically, it's just the SoftPull report doesn't lend itself to every transaction, but there are a high percentage of transactions and like I said, when I started utilizing the SoftPull credit, it was really a financial, kind of say
$30 on a tri-merge.
Yeah, it was
right?
me kind of being the CFO and saying like, hey, like the economics of like, let's quit, doing $30, hard pulls and racking up these huge credit bills on files that we're not even sure are going to go. It wasn't really until I got in and personally started using them on files that I, qualifying borrowers on, that I really truly learned all of the ways that I could use it, all of the tools, all of the benefits. And two, it's a huge benefit to the client. And on the sales side, it's a huge selling point to be able to tell the client, I'm going to do a soft pull. I'm sure you've probably heard the term. It's opposite of a hard pull. It's not going to impact your credit. We'll be able to get all the visibility. I'll be able to get you a much more accurate, and I hesitate to call it an approval, but I can get you a much more accurate, pre-qualification really, and then get them to a point where you feel comfortable that you are going to be able to get them approved. Then do the hard inquiry if you need to. And
so you guys lead with it in your sales process?
Yeah, absolutely. Yeah, for people that I know that are going to be tight on ratios.
In that position, not for the guy who's making $1 million and.
No, then it's yours. Yeah, no.
Yeah.
Then there's no point. But and I mean, when I came in today, I mean, we've built a custom integration into. It's such a part of our sales process. We built a custom integration with you guys into our CRM. I probably shouldn't be.
No. That's what we're rolling out next.
I shouldn't be pitching this to all the competitors. They're going to watch it, but no. I mean, we've instilled it so much into our sales process that I've created a button, custom development within our CRM. I'll pitch Optify now because I like
Sure.
John McGee and he's a super good dude. Where we just hit a button and it instantly pulls that soft pull. And then it's twofold. One, we can, at that point, most people are looking at pricing. So it gives me the opportunity to give them accurate pricing because then I'll know where their credit score is. So on that initial sales call, it gives me quick visibility. But then as we're maturing into the process, then it gives me all that data. It gives me, I know what their credit, the liabilities are and stuff like that. It gives me the ability to kind of push it forward. But it's such a part of our sales process. We went out and spent the money to custom development and have it dropped into our CRM. It's in our lead system.
So I don't know where you're at in your business as far as recruiting new LOs, but when recruiting a new LO or building the business, would this be a tool that you would talk to recruits about, a benefit like?
Yeah, no, absolutely. I mean, I mean, most people don't have it. Most people aren't using it, to be honest.
Or they think it doesn't work, right? Or they think.
And it's back to myself as the prime example. Like, sometimes until you really start using something, you don't understand all of the benefits, and I'll be honest. I mean, I think, and it's not just exclusive to your company, but I think a lot of people with the soft pull had led with, and this might be older, sales, but had led with the cost component of it. Like, hey, it's a lot less than a tri-merge. It was why, again, that I kind of initially started looking at it because I'm like, hey, man, why are we pulling all this credit?
You get a
$30,
$5,000, $10,000 credit bill.
Yeah,
right?
I'm like who's like? I mean, I look at it. I write the check on our credit bill every month, and I look at it and I break it down by loan officer, and I look at it and I look at pull through. I mean, I'm the CFO, I'm the CEO, I'm the CFO.
Yeah.
I mean, I look at those numbers. I look at what the pull through is. How many credit pulls were there? How many loans did we close? It's just like every other investor when we're delivering loans to them. They look at how many loans are we underwriting to funding, right? It's pull through. Everything's pull through. And so I initially was looking at the economics, the cost component of it. And it wasn't until I started using the product that I really recognized all of the other benefits. And it's one of the reasons why I still originate loans is there's a lot of stuff you can't learn through just talking to loan officers or whatever until you're actually doing it and doing it on live files. It's one of the things I always, I do a lot of the testing on all of our systems. I do the UAT through test files, then I do testing through live files because it's once you get into real time, real files, you really understand how everything works. And so like back to the kind of the sales piece, like leading with it to the consumer, I didn't understand that until I saw how I could use it differently, not just that it was cheaper than a hard pull, but that I could calm the nerves or talk a borrower or a potential consumer or borrower about moving forward through saying, hey, let me just do a soft pull, not going to impact your credit. I can figure out how much we can get you qualified. And they're like, oh, okay. But that was somebody that if I told them I was going to do a hard inquiry,
They're out the door.
They're done. They're like, let me think about it. And you're never going to get them on the phone again. So it's, and those are things that until you really use the product, you would never understand or fully understand the true benefit and how you can implement it and integrate it within the sales process.
It's funny because we always talk about, that's our sales pitch, right? Is it's going to save you time, it's going to save you money, and then you're going to get more deals because of the time saved, the money saved, and you're going to convert more shoppers because you're leading with it. But to hear a client talk about this, right, is great. So talking to your client right now, right? We'll wrap up with you talking to your client and saying, we've already really talked about it and worked around it, but talk to your client if you would and say like, why should they do business with Saxton Mortgage versus the competitor as it relates to, this topic? Yeah,
I mean, as you know, I own the company. I originate loans. I'll probably continue to originate loans. And it's, I tell people we just operate a lot differently. I mean, new leads that come in, I tell people I handle the file. And this isn't a pitch about why to do loans with me. It's just the way that we operate. It's, we process in-house. Our business model is we're delivering basically wholesale broker pricing with with a banker feel, and so we are a lender, but we take advantage of the best execution. So we're offering broker, traditional wholesale pricing in a retail environment. And so for us, we can give the best price. It's, we basically operate, and we do operate as the direct lender on these transactions. We do everything in-house. We're drawing all of our own docs. We do all of the disclosures. We do everything in-house. And the difference is that we're delivering that at a wholesale broker pricing. And so there's not many people that I know that are out doing that. There's a lot of margin that gets built in. And so, we handle the customer from start to finish. We do everything in-house. It's, why we have a, 4.8 star rating or something like that. I mean, it's, we just handle everything from start to finish. It's not, let me take this, a lot of these sales centers and stuff like that, they take the application, it gets pushed off, and then you never hear from somebody again. I mean, the originator handles the file from start to finish, and we make sure that, we get the loan closed.
All right. Thanks for listening to the iSoftpull main course podcast. We interviewed Trent at Saxton Mortgage. Thanks for coming out to the show, and we look forward to doing it again. Cheers. Thanks for listening. Subscribe to the main course for straight to the point business insights.